Netflix raising their prices after subscriber growth, home prices crashing in Austin, Texas, a big announcement out of Home Depot, other big announcements out of the buyers of Big Lots, the store, more record highs in the stock market. Hey, everybody, you're watching Bull Boom Bear Bust, back with another dose. We're going to go ahead and get into all that and more today. Please hit that subscribe button and make sure you're updated on all this stuff here, because it's a very important time to kind of stay ahead of the economic financial curve, as I like to say. And let's go ahead and start here with Netflix. We just talked recently, last report, 2 reports ago, about how Netflix had a big influx of subscribers. And a big part of that was that silly Mike Tyson fight. But now they're raising their fees. And according to many news outlets here, the company reported 19 million new subscribers during the last financial quarter, the largest subscriber growth ever, the largest jump during that quarter, during a 3-month period. It puts them at a total of 302 million global subscribers, folks. Netflix is killing it. And is it that Netflix is good, or is it there's not much else to watch on regular cable? Netflix also announced a bump in prices for all subscriptions tiers. Listen to this. The standard account, which now comes with ads, $7.99 a month. I'm just going to say $8. The ad-free subscription's $18 a month now, while the premium plan is $25. This reflects price hikes of $1, $2.50, and $2 per month. This comes months after Netflix's last price hike, when the company announced its least expensive ad-free option. So there you go. If people are going to continue to pile in and join and subscribe, they're just going to raise their prices, folks. If you want prices to come down, and this is not just Netflix, this is true anywhere you look, and it's simple. It goes back to supply and demand. If you want prices to come down, you're going to have to stop going into debt, stop spending money to buy these things. With the levels of debt right now, we have people out there, nothing against Netflix. I subscribe to Netflix. Would I subscribe if it were just up to me? Probably not. But I have a family. We have kind of a vote thing going on. I'm outvoted. And, 3 kids are all going to want Netflix, right? And your spouse. I was outvoted 4-1, basically. So, folks, this is true everywhere you look. And if the banks are going to keep lending, people are going to keep spending, and prices aren't going to come down. In fact, we're going to talk about what's going to be happening with the banks. And to me, it's going to be very, very inflationary here. Actually, let's jump to that right now. Then we've got some Home Depot news, some other news, the stock market as well. And here's how they put it over at Reuters. Wall Street banks sense opportunity for looser capital rules under the new administration. Folks, we warned about this, right? The new administration is a lot, not all about, but a lot about deregulation. And of course, if you're someone that wants to make the economy look good, are you going to make it easier or harder for people to borrow money? Are you going to make it more difficult or make it easier for banks to loan out the money? Of course, you're going to make it easier, right? Because the economy is based on how much debt people are accumulating. And some will say, well, it's spending. Well, yeah, it's spending. But when you look at the savings versus the debt increase, it's mostly debt-driven spending that's fueling the economy right now, and what's looked at as economic growth. Most of you know this. So yeah, looser monetary policy out of the banks is what I'm seeing here, and that's what Wall Street banks are sensing. And that's a lot of the euphoria in the stock market as well, because more people spending money, even though it's borrowed money, that's more money for big companies, bigger profits, and a lot of it will stay up at the CEO level. And, some will trickle down to the workers, but as little as possible will trickle down to the workers, because, of course, they want to buy back their own stock to boost the stock price, which is a further upward pressure on the stock market prices. In fact, we had a new all-time high in the S&P 500 here just today. S&P 500 touches a fresh record, and a lot of this is on optimism and that deregulation, where people see helicopter money basically not dropping from the sky, but put into these credit cards that people are swiping to keep on spending and go further into debt, even though charge-offs have been increasing, right? With credit cards, with loans, and delinquencies are increasing, they're still talking about more deregulation, folks. So more of the same that got us here is going to be more fuel on the fire, folks. So get ready for that and invest accordingly. Now, things aren't as sunny everywhere you look. I mean, there's layoffs happening. In fact, there's a big shift right now between kind of political lines as far as the layoffs that we're seeing here. We've got CNN laying off hundreds of employees as transformation begins, right? And there's a few different things we want to look at with this as far as like the political lines that are being drawn here. Let me just bring up a recent chart here that I found. And this was put out in a recent news broadcast, fellas. Don't be staring over here. Don't be looking over there. And it divides it up between political lines. We see lefties there with the blue line, and we see the increase from 2010 through 2016. And many would argue that was just coming out of the financial crisis. So, of course, they would have seen an increase. Then we see the continued increase up until it plateaued about 2019 under the right-wing administration. And we remember interest rates were increased in 2019. So there's that economic activity slowdown and therefore the manufacturing slowdown. Of course, the big drop came in with the health crisis, then the recovery. And then you can argue again that this growth here coming out of that crisis was based on just things getting back to normal, things opening back up. But then since about mid-2022, kind of flat, right? So we're going to see how this plays out, folks. I don't really see a lot of manufacturing coming back to the U.S. with the debt levels right now. And I hope I'm wrong. I hope tons of jobs come back to the U.S. But with the debt levels that we're currently at right now, without some massive debt forgiveness, I don't see how people are going to continue to go further into debt. We're already at all-time high debt levels, and we've already been there for a couple years. Even higher interest rates didn't stop people from spending. Even rising charge-off and delinquencies didn't stop people from spending, and banks are still loaning out money. Even banks that are increasing their write-offs and credit card companies. Take a look at this. Check out this recent headline. Capital One card charge-off rate rises. Delinquency rate stable. Now, before December, the delinquency rate was increasing. But even though charge-offs are rising, we're not seeing credit card companies or banks tighten for the most part. In fact, most of them are still loosening. About 80% of the banks right now and credit card companies are loosening, meaning making it easier to hand out credit and making it easier for people to borrow money. And here's how they framed this situation over at Marketplace. Consumers are still strong despite rising debt delinquencies. Let me go ahead and rephrase it though. Consumers are still able to spend as long as credit card companies are still going to extend credit. And we know that credit card companies, banks, especially the big banks, are not going to be allowed to fail. So there's the confidence right there that I think a lot of people, including the markets, are sensing, and the deregulation that's about ready to happen. And also, my guess is that we're going to start seeing posts on social media, maybe tweets or X posts, etc., that are going to start calling for lower interest rates to make it easier for people to handle this debt. But again, I think it's too little too late because the debt levels are so high. An interest rate cut, how many people is that going to help right now with these debt levels where they're at? Right? Everything is so unaffordable. Here's a recent headline out of Axios. Income needed to buy a home in San Diego. Folks, over $240,000 annual income needed to afford a median-priced San Diego home. You need to afford nearly $250,000 a year to afford a San Diego home. And it's not just downtown San Diego. Even on the outskirts, like places I wouldn't want to live, you're seeing $600,000, $650,000, $700,000, $750,000 homes in bad neighborhoods. And I don't think I'm talking about just San Diego. It's like that in many cities now. Places you wouldn't even want to live, you don't feel safe. You're going to be paying over $500,000 for a home. It's bonkers, folks, but I think it's likely going to get worse, even with all the other deflationary measures that are being implemented. But again, there's so many different things to look at right now as far as all the new executive orders, the deflationary dropping of the population would be deflationary by itself. But then you have these other inflationary risks with the banks, with the lending, with the system of money. All right, let's shift gears a little bit, folks. Look what is happening in California. I almost can't even talk about it because it's very interesting. Look at this. Homeless people being evicted, sent eviction notices. Out of Mission Local, homeless families sent eviction notices from San Francisco shelters. When Miss Ortiz, a 26-year-old living in the Salvation Army Harbor House homeless shelter with her husband and 7-year-old daughter, will be evicted in March. January 21st, Ortiz stood in a room of 200 city council people, with others also facing eviction. Wow, 200 people. They handed them a letter demanding a meeting to address their urgent needs, asking the mayor to rescind the evictions, folks. They're evicting people. Here's the letter. Evicting people from homeless shelters. All the money that we give out all across the world, we're evicting people from homeless shelters, folks. This is absolutely bonkers. Will somebody step in? Will the Fed step in and take care of this, or is this just going to remain on the state level? And if California and the ones that are running it, if we're so compassionate and we care about people so much, why are we evicting people from homeless shelters? It's a mind blower to me. But then again, does anything surprise anybody anymore? Is there any news that I could bring out here that would actually surprise or shock people anymore with everything that we've seen so far? And if you didn't think it could get more absurd, take a look at the headline here. Jamie Dimon says U.S. stock market is kind of inflated. Kind of inflated? Do you think so? Do we need a multi-billionaire to tell us that the stock market is kind of inflated? So is this why this guy makes hundreds of billions of dollars in pay and bonuses and stock options? Right? Kind of inflated, folks. I mean, he's been saying stuff like this for a while. He's been saying that the train's going to come off the tracks and that there's storm clouds on the horizon. Yeah, there's storm clouds on the horizon if banks are actually held to account and are responsible for the money they loaned out. Until that ends, folks, you're just going to keep seeing more all-time highs in the stock markets, more spending, and therefore rising prices. I hope I'm wrong on this. Please let me know if I'm wrong on what you disagree with or agree with down here in comments on this channel, please. Let's talk about Home Depot, people. Home Depot just made a multi-million-dollar announcement. What they're doing is they're teaming up with delivery companies to deliver products from Home Depot. So I guess if you're someone like a handyman that doesn't want to go run to Home Depot, you can call up and say, hey, deliver this to this address. And they're going to be teaming up with these food delivery companies, Uber and others. So pretty smart move if you ask me. I know somebody that works on houses, and he says one of the baddest things is when you get to a job and you don't have the right fitting component or the right tool, and then you have to run to Home Depot. He says it makes it twice and 3 times as long having to leave the area where he's doing the work, run to the store, run to Home Depot and back. So this could be a nice way for Home Depot to boost their profits, and maybe it'll create jobs for the delivery drivers. We'll have to see. But the convenience is just money out of the consumer's pocket, because if you're paying for convenience, then you're paying more total, just like the food. You're paying a lot more for your food when you get it delivered. And is it worth the convenience of being able to sit on the couch and continue to watch TV or fix stuff if you're a handyman, getting these things delivered? Pretty interesting, though, with Home Depot. And now also news today, the buyers of Big Lots are not saving hundreds and hundreds of store locations. Remember, we talked about it. We weren't sure at the time when the purchase was announced or the acquisition was announced. They're still going to be closing hundreds of low-performing stores. So the people that were wondering if your local Big Lots is going to stay in business, or if it went out of business, if it was going to reopen because of that acquisition, it's probably going to stay closed, according to the recent news that I read here today. One more thing here, folks, before we wrap it up here. We've got egg prices still crazy. I was at the store earlier, $8 nearly per dozen. There is a store you can find them at for like $3.50, but you got to get there right when they open. My wife tells me not to tell people what store it is, but I'm going to tell you anyway. It's a store out here called Trader Joe's. If you're in California, I think they have them in Vegas, and maybe it's nationwide, but I've definitely seen them in many cities on the west here. It's Trader Joe's, but you got to get there early in the morning. Don't tell my wife that I told you. $3.50 a dozen if you get there early enough. Egg prices skyrocketing. One more thing I wanted to get into before we wrap this one up here. Did we talk about the homeless shelter evictions? Yes, we did. Yes, we did. One more thing here. Found this. Advanced Auto Parts. Big layoffs, folks. And closing stores. Well, they were announcing layoffs. Now it's closings. 200 leased location and 24 owned stores. So over 220 locations. Advanced Auto Parts shutting down, folks. So sign of the times, folks. People are still spending. But depending on where you look, you'll see the effects either positive or negative, basically as people shift their spending habits. And we see Netflix skyrocketing, but auto parts stores closing, right? Pretty interesting. So watch your money, watch where you're invested, and we're going to be back with more economic news. Please make sure you subscribe. Let me know what you think about all this down in the comments. The Netflix increasing their prices after the subscriber growth. The Home Depot delivery situation coming up now with the Uber and other delivery companies. The big home price drops in Austin, Texas. Look at this. Some drops as big as 50% on some listings in Texas as people try to bail out. That was one of the biggest rises in home prices with Austin because all these people from California and elsewhere from the West Coast zoomed into Austin. And we told you that was going to happen, folks, there. So anyways, hope you guys are good. As always, keep stacking. Let me know what you think about all this down in the comments. Big love. Bye for now. Peace.